Good afternoon, everyone, and welcome to this online event that we at the Institute for Fiscal Studies are running over the next hour. My name's Jonathan Cribb. I'm an Associate Director at IFS, and I'm delighted you're here for this event, which is going to involve three great speakers, including on our new research, which was released earlier today, on wealth transfers during life, and we'll be finished today with a question and answer session. The first thing I'd like to do is just to thank the UK Research and Innovation, who have funded this work through the Economic and Social Research Council, and to the IFS Retirement Saving Consortium, which is a consortium of institutions who are interested in supporting high-quality research on retirement savings and related issues. So that's Age UK, the Association of British Insurers, Association of Consulting Actuaries, Canada Life, Interactive Investor, the Investment Association, Money and Pension Service, and the Pensions and Lifetime Savings Association. So we are very grateful to the support provided by them. So our three speakers today in order are David Sturrock and Bea Boileau, researchers at the IFS, who will present on some of the new work that we have released today. And then we're delighted that Lord Willett is able to join us to give his own perspective on these issues. I will let each of those speakers pass from one to the other, and then that will take just over half an hour, and then roughly the last half an hour will be time for questions for our speakers. Please do use the Slido app to put your questions in there, or to upvote the questions that you think are particularly pertinent and that you want to get answers on. So that's enough from me. I'll hand over to David Sturrock to start us off and with his presentation. Please take it away, David.
Thanks very much, Jonathan. So as Jonathan said, I'm going to be kicking things off talking about who gives and receives lifetime gifts and loans in Britain. So before we get into it, why are we looking at this question and these wealth transfers in the first place? Well, we know that there's increasing levels of wealth held by those at older ages in the UK, alongside stagnating earnings growth for those of working age. And as a result of that, in recent decades, we've seen that inherited wealth has been growing compared to people's earned incomes. And we think that that's going to continue as a trend going forward in the coming decades. But we also know that as people are living for longer, those inheritances are going to be received progressively later in life. On average, we think that people will be inheriting when they're getting into their early 60s in the coming decades. As a result of these trends, we think that transfers that are made during life, rather than inheritances left after people pass away, are worthy of a particular focus. As a result of the trends that I've just mentioned, they might be becoming more common. It might be that people are choosing to pass on some wealth while they're alive, when their kids are a bit younger. They might be becoming larger and potentially more consequential due to the circumstances faced by younger generations. It's also possible that these transfers that are made during life can be more responsive to particular events or particular needs in the lives of the givers of those transfers, or to events in the lives of the receivers of those transfers. So we might think that while inheritances could be important in kind of bolstering people's retirement income resources later on in life, those are going to be received generally at the end of people's working lives. Whereas these transfers that could be being made earlier on in people's lives might have more of an impact on their other decisions in their career, for buying a home, things like that. But despite the potential importance of these transfers, we actually know relatively little about who's giving and receiving them and why. So to try and fill that gap, we've conducted this analysis using data from the Wealth and Assets Survey. That's a representative survey which asks people about gifts and loans that they have given and received that are worth £500 or more. Now, we include loans within our analysis because while they will often be paid back and might not be seen therefore as a transfer, loans that are received from family and from friends might be given on a favourable basis. And indeed, we actually see that a substantial minority of people say that they don't intend to fully repay those loans. So what are we seeing in terms of trends over time? Well, we see that gift receipt looks to have become slightly more prevalent in the last few years. Here in this chart, I'm showing the percentage of adults, that's those aged 20 and over, who report receiving at least one substantial gift over the previous 2 years. That the rate of gift receipt has increased from about 4 to 5% up to around 6% in the last few years. About 2% of people each year report receiving a substantial loan. So together, about 7% of adults are reporting receiving one of these substantial transfers over a 2-year period. And just to give you a sense of scale, the median size of these transfers amongst those that receive something is about £2,000. That's the case for gifts and for loans. But the largest 10% of transfers are over £20,000 in size. So these transfers are really unequally sized. A small number of very large transfers and a greater number of those of more moderate size. And in total, they add up to make a flow of wealth, which each year is worth about a fifth of that for inheritances. So smaller, but still substantial. And we see that that flow of wealth is primarily going from those at older ages to those at younger ages. Here I'm showing the percentage of people who report receiving one of these transfers in the last 2 years by age group. And we see that the prevalence of receiving a gift or a loan peaks when people are in their late 20s and early 30s and then declines as people age. And on the right-hand side, I'm showing the percentage of people who report giving one of these transfers over a 2-year period. We see that the rate of giving really steps up as people move into their 50s and then stays at that higher rate through the retirement years. And not only is this wealth flowing from those at older ages to those at younger ages, in particular, this looks to be, in the vast majority of cases, a flow of wealth from parents to their children. Here in this pie chart, I'm showing that 83% of the value of gifts that are made are going from parents to their children. We see much smaller contributions from other giving relationships. So 2% of gift value actually flowing in the other direction from children to their parents, 3% being received from grandparents or great-grandparents. Now, we might wonder whether some of the wealth that's received from parents is in fact an inheritance, say, that they received from their parents and then are passing on to their kids, so kind of indirect grandparental giving. But we found, looking at that only about 3% of the value of inheritances received from people other than your spouse were passed on as a gift over the same 2-year period. So it really does seem that the vast majority of this wealth transfer is going from parents to their children. We see a similar pattern when we look at loans, slightly lower contribution coming from parents and a bit more from other relatives and from kids to their parents. So what are these transfers doing to inequalities in economic resources when people are in their early adulthood? What we do here is to focus in on those who are in their 20s and early 30s. And we're able to follow a group of people for 8 years in that time. And then we add up all of the transfers that they receive in that period, and we're going to compare it to their other sources of income received over the same time. So first of all, here I'm showing that 30% of young people over an 8-year period receive at least one of these transfers. But the rate of receipt is very different according to how much income you receive over that same period of time. For those in the top fifth by incomes, more than half are receiving one of these substantial transfers. That compares to just 13% of those in the lowest income fifth. And those with higher incomes are not only more likely to receive these transfers, they receive larger amounts, and those transfers are worth more expressed as a percentage of their income. So, for example, those in the highest income fifth receive transfers that are worth about 2.5% of their income over the same period, compared to about 0.5% for those in the lowest income fifth. Now, perhaps it might not be surprising that these sorts of transfers increase inequalities, but it is actually an interesting contrast with inheritances that are received later on in life, where those who have lower levels of income and wealth actually receive the same amount or even slightly more in terms of inheritances when expressed as a percentage of their economic resources. And in the case of these transfers, they are expanding inequalities. We can think about inequalities not only across the income distribution, but also think about how much is received by those with richer or poorer parents. Here in this chart, I'm showing how often people receive transfers and how much they receive as a share of their income, splitting young people into those whose parents rented their accommodation when they were younger, those who have homeowning parents but without a university degree, and those who have university-educated homeowning parents. We see that those parents who are homeowners and who have higher levels of education, the children of those people are receiving a larger amount in terms of transfers as a percentage of their income. And what that means is that these transfers look like they're strengthening the relationship between parents' economic resources and that of their children. That is to say that they are decreasing this measure of social mobility. And that finding is reinforced by the additional fact that more than half of the total value of gifts that are made by those in the wealthiest fifth of adults. So clear evidence of this kind of role for strengthening relationships between economic resources in different generations. We see some important differences in receipt of transfers along other dimensions too, notably by ethnicity. Here I'm showing in this chart the proportion of those in their 20s and 30s who receive a substantial gift split by ethnic group. We can see that while those white young people, about 1 in 10 of them receive a substantial gift in any 2-year period, those rates of receipt are much lower. For example, for those from Pakistani or Bangladeshi backgrounds, where about 1 in 30 are receiving a substantial transfer over a 2-year period. Slightly higher, but still low rates of receipt for those from Black Caribbean or Black African backgrounds. The rate of loan receipt is more similar across ethnic groups, but that difference in the receipt of gifts, which is probably at least partly driven by differences in the wealth of the parents of these different ethnic groups, is therefore looking like a mechanism whereby ethnic gaps in wealth could be passed down from one generation to the next. So just to summarize, we've seen that wealth transfers made during life are primarily a flow of wealth from parents to their children when their children are in early adulthood. Those transfers look to increase inequalities in economic resources. The overall effect there is modest, but it's certainly not negligible. These transfers also expand the gaps between those with richer and poorer parents, that is, they decrease social mobility in early adulthood. And finally, we see some large differences in gift receipts between ethnic groups. Pakistani, Bangladeshi, Black Caribbean, and Black African young adults are much less likely to receive these gifts than are white young adults. That's all from me, so now I will pass on to Bea.
Thanks very much, David. I'll now be talking about what drives the timing at which these gifts and loans are made. And this is motivated by the fact that these transfers come quite infrequently or on one-off bases, rather than being a continuous flow between generations. So here I show you the number of waves in which people who are present for 7 waves of our data report receiving transfers in, and it's among people who receive at least one transfer. As you can see from this, the majority of people are receiving a gift or a loan in only one of the waves in which we see them, and no one that we observe receives a gift in all 7 waves. And this indicates that these are much more likely to be one-off and prompts the question of what drives the timing at which they're made. And so in order to investigate this, we use the fact that our data set links the same people over time. So we're able to construct these measures of life events, which might be associated with giving or receiving a gift. Here I show you a list of the life events that we consider. I'm not going to go through all of these in detail now, but you can see that we can observe people who are unmarried in one wave of data and then married in the next, and test whether that transition seems to be associated with a higher likelihood of receiving a gift or loan for people who are similar on other demographic characteristics. It's worth noting that for many of these events, the causality will kind of run in both directions. So for becoming a homeowner, for example, a gift might be given to help people move into home ownership or to celebrate that move when it's been made. So we can't make any definitive statements about causality either way for some of these. And so I'm going to show you the evidence from what we found performing this analysis. So as you can see on the x-axis here, we've got the life events that we construct for receivers. And on the y-axis, we've got a measure of the association between experiencing one of these events and the probability of receiving a gift over the last 2 years at the same time for similar people. You recall from David's presentation that around 1 in 10 young adults report receiving a transfer over the last 2 years. Home ownership is associated with an increased probability of receiving at least one gift of 10 percentage points, meaning it's associated with the probability of receiving a gift roughly doubling. The same is true for marriage, but moving between regions, self-employment, separation or divorce from your partner, having a new child, experiencing a decline in employment earnings, and moving into unemployment from employment, none of these events seem to be associated with a higher probability of receiving a gift. And it's worth noting that these gifts are above £500 in value. So this is consistent with other evidence showing that these events are associated with lower transfers. And they might also be associated with different kinds of help. So for example, moving back in with your parents or practical help. It's interesting that home ownership and marriage stand out here. It indicates that these gifts are functioning as ways for young adults to overcome credit constraints to complete expensive life course stages, rather than the gifts and loans functioning as intra-family insurance. There are also important differences by the wealth of people's parents in this regard. So David's talked about the fact that people whose parents rented their home are more likely to receive less in transfer value and less likely to receive transfers. When we look at the associations only among those people whose parents rented their home when they were 14, you can see that the same associations still hold. So home ownership and marriage are still associated with higher probabilities of receiving, but the size of that association is lower. So home ownership is only associated with a 5 percentage point higher probability of receiving a gift. Looking at those whose parents were non-university educated homeowners when they were 14, you can see that there are slightly larger associations for home ownership and marriage. But it's looking at parents who are university educated homeowners, you can see that for the children, there's a much stronger association between experiencing these life course events and receiving, indicating that not only are these gifts more likely for those with wealthier parents, but they're also more likely to drive life course events like home ownership and marriage. We've also got self-reported evidence that helps back up our analysis here. People are asked directly what they use the gifts that they receive for. And here I show you the proportion of gifts that were reported as used for different reasons. As you can see, property is clearly important here as well, with 23% of gifts received used for property purchase or improvement. But there are other important uses that stand out here. Saving or investing gifts received represents a large proportion of gifts, and using gifts for living expenses is 15% of gifts. There are also events like going on holiday, which represents 9% of gifts used. But when we weight this by gift value, property purchase is clearly the most important use of gift value. So more than half of gift value transferred is used towards property purchase or improvements, indicating that not only is property purchase an important use, but it's associated with much more valuable gifts. When we just look at people who use their gifts for property purchase, the average size of the gift was around £20,000. So these are really important in passing on inequalities, as David discussed. And again, as David said, there were differences between those with parents of different levels of wealth. And you can see that using this self-reported evidence, there's also a higher proportion of gifts used towards property. This shows you the proportion of gift value used by different parental backgrounds. And you can see that those with the wealthiest parents devote more of the gift value they receive towards property purchase or improvement. And again, this helps create or embeds inequalities that are then augmented over time. We've seen that there are some events that trigger gifts to be received for receivers, but looking at givers, there are also some events in givers' lives that might trigger gifts to be given. So here I show you 5 events that we've investigated in the lives of givers and their association with making at least one transfer of £500 or more. Being widowed between rapes is associated with a higher probability of making a transfer, and as is inheriting more than £1,000 between rapes of data. Beginning to draw a pension though, paying off a mortgage and retiring between rapes aren't significantly associated with a higher probability of making a transfer. There are important differences by sex here. So when we look at men alone, widowhood doesn't seem to be associated with a higher probability of making a transfer, but inheritance is associated with being more likely to pass on a gift of £500 or more. Looking only at women, inheritance does remain significant, although it has a smaller association, but widowhood seems incredibly important, associated with a 20 percentage point higher probability of making a gift of £500 or more. And this might be a response to a change of financial control within a household, or might indicate women being pressured to make choices that aren't perhaps in their best financial interests. So I've shown that these sorts of transfers tend to be infrequently made, suggesting a focus on what drives them. I've shown that home ownership in particular is associated with being more likely to receive a gift, whereas adverse effects like losing your job, experiencing a fall in earnings, or separating from a partner don't seem to be associated with a higher probability of receiving a gift. And this is consistent with the idea that gifts and loans are associated with helping younger generations overcome credit constraints for costly expenditures, rather than performing inter-family insurance. We find that there are stronger associations with home ownership for those with more affluent parents, with implications for inequalities. For givers, we see that receiving an inheritance and being widowed are associated with being more likely to give a gift, but there aren't any strong associations with more predictable events, such as drawing a pension, retiring, or paying off a mortgage. Interestingly, we find that the effect of being widowed is especially strong for women in terms of the likelihood of making a gift, which we argue might reflect a changing control of household finances. That's all from me, and now I'll pass on to David.
Great, thank you very much indeed. And I congratulate the IFS on this really interesting and significant report. And speaking as a member also of the board of UKRI, I'm pleased that we funded this excellent piece of research. I'd just like to bring out kind of 3 implications of it, because I think the analysis is very strong and bears up to very careful and close scrutiny. First, of course, inevitably, the analysis is simply on the financial value of these gifts. Their real long-term value may not be fully captured simply by the amount of money involved. If it makes the difference between getting started on the housing ladder or not, and it was fascinating to see how much this is linked with buying a flat or house. If it makes the difference between staying as a renter or becoming a homeowner, then your lifetime housing costs are going to be significantly reduced compared with staying in the private rented sector. And of course, if you're a homeowner, that in turn gives you an asset base which you can leverage in the future. Even, setting up a business is closely associated with owning a property, and therefore having a security that you can use it to borrow if you want to meet the costs of your business. So we're talking here about these gifts helping to fund significantly different paths through life that bring with them significant benefits for the people receiving the gift, certainly on the larger scale of some of them. So the figures on their own don't, I think, fully capture the importance of these transfers, which the IFS has so usefully been identifying. That's my first point. My second point is really about what this tells us about attitudes. And it's striking how much of what we're talking about here is parents trying to help their children. And that, of course, is admirable. And it's great that there are still these intergenerational exchanges. Here, of course, mainly happening within the family. We see that parents really want to help their kids and are willing to give them money to help them get started in life. This is behavior it's hard to criticize and is admirable. And of course, it's quite astute support. It's coming in at key points in the life cycle when that help is of greatest value, particularly when people are forming long-term partnerships and wishing to buy a house or a flat. So all that is good news in a way. It tells us that the generational contract is strong. It's operating at the crucial moments when young people need help the most. But it's only within families. And in a world where assets matter more and more relative to incomes, and look, the IFS figures today show it, work we've done at Resolution has shown it, where the ratio of value of assets to GDP to national income has gone from 3 times 30 or 40 years ago to almost 8 times now. In a world where wealth really matters more than it did, and relative to earnings matters more, these intra-family exchanges are both very powerful, but sadly reinforce the advantages of people who can inherit be given wealth. It means that acquiring savings out of earnings gets harder. Acquiring assets by gifts becomes more and more significant. And this leads on to my third point about policy, because really it shouldn't just depend on parents. We may be admirable parents trying to do this for our own kids, but I don't think we're as good citizens as we are parents. What we're trying to do for our own kids as parents is also in some ways what surely across public policy we believe should in general be provided by way of assistance for young people at crucial stages in the life cycle. And that's why at our Intergenerational Commission report, which I chaired, one of our proposals was for a capital grant of about £10,000 made available to young people at that crucial stage in their lives when it looks as if parents are helping their kids if they can afford to do so. So although the exact age is obviously open to debate, you could imagine at the age of 30 and something worth £10,000 that would rather match the kind of voluntary transfer some parents are giving. You could specify what it was to be used for. It could be for purchasing, helping put down a deposit to buy a house, or even just a deposit to help you rent a flat or a property. That could be the first use, housing. Secondly, you could put it into your pension pot. And if you put £10,000 in at the age of 30 into your pension pot, by the time you reach the age of 60, it's going to be worth a hell of a lot more. It's a great time to boost your pension. You could thirdly use it for setting up a business. You could fourthly use it for some contribution to education or training. But that kind of advantage, which a small subset of young people having from voluntary gifts, should be available more widely. And if it was £10,000 and the average age cohort at the moment is about just over 700,000 young people per year, so you'd be talking about £7 billion, which is less than 1% of public spending. Because I do think that this IFS research sets us a challenge, which is, given that this parental support is quite well targeted and well intentioned and quite smart, aren't there some lessons here for us about what a well-designed public policy could do as well? I used to work for Margaret Thatcher, and I remember the days when the focus of the Conservative government was a property-owning democracy achieved by, first of all, selling council houses at a very large discount, and then when nationalised industries were being privatised, of course, we made shares available for people at discounted prices as well. Those were significant transfers, often to middle-aged or younger people. We should have a revived commitment to spreading property-owning democracy to the next generation now. And this important piece of work today confirms my instinct that a capital grant for all young people, once they reach the age of 30, it would be a great way to do that. Thank you very much indeed.
Thank you, David, and thank you to David Sturrock and to B as well. Now joined by all the speakers, and we're going to look at some of the questions we got. So what I'll do is can look at the ones on Slido, see what's been upvoted the most, and I'll direct the question to one of you, but please do come in if either of those who I don't direct it to has a desire to jump in. The most upvoted question we have is whether some of these transfers are likely to be driven by people trying to avoid inheritance tax. Maybe I can send that to B. Have we looked at that at all, or do we have any evidence of that?
We don't have any hard evidence on that, but I'd be surprised if it wasn't the case that some of these transfers are being made in hopes of avoiding inheritance tax. There's definitely a difference in tax treatment between the two types of intergenerational flows, inheritances and gifts.
Maybe I can add something on that and what we know from some other bits of research that have gone on in the UK and elsewhere. So I guess firstly for context, in the UK, about 4% of deaths result in any inheritance tax being paid. So on some level, it's kind of a minority concern potentially, which it doesn't mean people might kind of mistakenly think they're going to pay and pass on wealth as a result. But not many people do. But actually in some other research that HMRC did in conjunction with IFS, where they asked people about some of the motivations for making gifts during life, we actually saw there that many people didn't really understand the different treatment and the rules, and an even smaller proportion said that their giving was motivated by inheritance tax avoidance. So I think that it probably is a motivation for a minority, a wealthy minority. But I think that most of the transfers that we're seeing are probably not primarily motivated by that, and are more just people wanting to pass on wealth because of the situation of their children, for example.
Okay, and the next question I think is interesting. Got lots of votes. Are these results important in themselves, or are they only important because incomes are stagnant and so few houses, meaning you need to be able to you need help, financial help, to be able to buy them? And maybe I can even take my own twist on that question and abuse my position here. But, you know, I guess another way of putting that is, to extent that this is maybe a problem, there will be reasonable disagreement upon that. Is it a problem in itself, or is this a symptom of deeper problems? And should we be thinking, at a deeper level in terms of productivity and housing, rather than worrying about this in particular? Maybe I can direct that to you, David Willetts. What do you think about that?
Yeah, I do think a world where wealth matters more relative to income is one where the kind of transfers that IFS have identified, is more significant. And the feature of this world is that using income to acquire an asset has got harder. The value of the total stock of wealth held by older people, parents and grandparents, has increased. So getting money from them has become a bigger and more important source of assets, and acquiring them out of earnings has become tougher. So it reinforces a picture of the world which people do worry about. When I first got involved in public policy many decades ago, I didn't think that by this age I'd be looking at a world where inheritance mattered and gifts like this matter more and earnings matter less. So yes, it's really playing into a much wider perception. That's why it's struck a chord and got so much media coverage today.
Bill, David, do you want to come in on that, or should I go to the next one?
I think I would say, I agree with the point that's being made, and what both Jonathan and David were saying. I think that I think it's right that the ideal kind of solution to this, insofar as you see, is there a problem, or the problem that might be coming in terms of the inequalities and access to this wealth. you'd ideally like a situation where that didn't matter too much to people's outcomes, where, whether or not you have parents who are higher up the wealth distribution wouldn't be, a strong determinant of whether you could buy a house. And how does that come about? Well, by making it more possible for people to save up, say, a deposit for a house through their own earned income rather than relying on parental wealth.
Okay. David, sorry, maybe I can pass the next one straight back to you. To what extent do you think the expectation of inheritance, or maybe we can broaden that out to the expectation of some of these, financial transfers between living people, might influence behavioural decisions that younger people make around home ownership or saving for later life? What do you think there?
Yeah, I think that's a really interesting question, and we've looked at this a bit in some previous IFS research. So people do seem to have kind of quite well-formed ideas of how much they're going to inherit in the future, and it kind of seems to stack up in terms of those that kind of have wealthier parents are kind of expecting to inherit more and so on. It does seem, though, that in terms of inheritances coming relatively later on in life, also there's always going to be some uncertainty about how much is going to be inherited, that it kind of looks like people are probably holding back to some degree in terms of, say, saving less or spending more in advance of receiving those inheritances. And that's probably particularly true for those who have less in terms of other resources in the first place, because they kind of can't afford to take the risk of not saving in the expectation of receiving an inheritance. I think maybe the more interesting question that unfortunately we don't really have very good evidence on yet is whether expecting to receive, or even just the possibility of being helped out through these lifetime gifts and loans, could have an impact on people's choices, say maybe taking a slightly riskier career choice, knowing that if things go wrong, you can fall back on parental help. I think that's, certainly a possibility, and it's something that I think we want to investigate more. Unfortunately, I can't give you anything concrete on that today.
Could I follow up on that by just adding another way in which these gifts and prospective inheritances might affect behavior, which is whether there's any implicit reciprocity in any of this? There's been the interesting observation about gifts and loans. I'm thinking about different forms of reciprocity. What if the reciprocity is social exchanges, such as, of course, we're really keen to help you get started on the housing ladder now. I'm sure if we as the parents get very old and frail, you will help out with some care, won't you? Or, of course, we're keen to help you get started on the housing ladder, but it might be great if you could stay in the area, and we'll help you with this gift, provided you don't move too far away. So this is all about the growth in the significance of the family, which is not what 21st century modernity was supposed to look like. And it may in turn help explain other factors, such as, for example, young people being less geographically mobile and less mobile than we expected. So this is also about strengthening the whole host of implicit family ties. And there may well be something in return, some other effects on the behavior of the recipient.
That's very interesting, because a lot of thought more generally on how we fund health and social care and pensions is about these, maybe at a more societal level, these contracts rather than within the family. And clearly we also know that there are societies where rates of co-residence, for example, between elderly parents and children are much higher than in the UK at the moment. I think we predominantly in places like East Asia. So whether there is a direction towards that seems interesting to me.
Yeah, well, maybe the gift is to get you out of the parental home, but not too far away. That's another possibility. So it's all these subtle exchanges, and we're getting beyond. This is what King Lear is about. But we are, and it's so delicate, and it's where economic transaction and social exchanges come together.
And we sort of add more mundanely, we do see, I think, a reduction in how frequently people who with university education move away from where they grew up. So it could be happening.
I'm going to come to a next question, which I think has been partially answered, but maybe I can get David Sturrock or B to reflect on this. There's a question from David Vincent here. Will not earlier than expected transfers of wealth exacerbate inequality, e.g. by facilitating house purchase sooner? Now, feels to me we have touched on a little bit here. I wonder if you can reflect on, there seems to be a bit of a tension that unless this money is otherwise spent by the kind of parent, older generation on whatever they would like to spend it on, it will either be gifted or ultimately transferred at the end in form of a bequest. And there's a kind of tension there, because you said that bequests are essentially inequality reducing, but these transfers are somehow inequality increasing. And is there something special? Is there something particularly special in terms of inequality about when this, comes in the life cycle? David Sturrock, any thoughts on that?
I guess the first thought would be, I kind of, as other David was talking about earlier, I suppose if receiving that transfer causes you to do something differently, which kind of has as an economist, you'd think of it as a high financial return. But to take the housing example, when you buy a house, you buy it with a mortgage, and that means that, we call that, it's a leveraged holding of the asset. And if it kind of goes up in price, which it's tended to do in the recent past, then that's going to give you a particularly high return to that wealth, higher than if maybe it was just kind of kept with the parents in their housing wealth, or in the form of a savings account. So that's one way. But I guess just more broadly, if it kind of interacts with what you're doing in your early career or early life, then it might have some different effects there.
Yeah, I'm going to go a little bit. Oh, sorry, David.
No, after B. After B.
Sorry,
well, I was going to go B to B for a different question. So you jump in on that question if you want to. Otherwise, I'll go to B for the next question.
Yes, in that case, I just wanted to say, of course, and again, it's previous IFS research on inheritance has painted a slightly different picture. But I think what this brings out is how different the gifts are. The gifts are happening, to put it very crudely, from parents in their 50s and 60s to kids in their 20s and early 30s. Inheritance is at a completely different stage. The median age of inheritance is something like 62. It comes much later. And your own research separately has shown that, of course, a lot of the wealth that's passed on in inheritance is housing wealth, which is fortunately quite widely distributed. I think that's one reason why inheritance proves at the moment to be relatively egalitarian from IFS's own research, as this is not talking, because most people currently in their 70s are homeowners. This is a different type of transaction at a different stage of the life cycle, and it's perfectly plausible, therefore, it is significantly less egalitarian.
Sounds right. B, I'm going to come to you on a question a little bit lower down here. The question is, do you have data on whether gift receivers are spending the donated money on university education? Now, you showed us the importance of housing. Is there anything on that? And in particular, is there any? Do we worry at all whether kind of particular things are missed? Do we worry about whether, if your parents pay off your student loan or pay for a master's degree or things like that, and the things that have become more common over time? Do we worry about missing that? And have we put any thought into what's going on there?
Yeah, I think the problem of potentially missing some of these transfers is something we've thought a little about, and perhaps something that's a bit inescapable. And studying questions of this sort through survey data, it's always going to be a question of whether people think of some transfer that they've received as a transfer or whether they don't. For education, we do see that a small proportion of the gifts we look at are associated with education in a broad sense. So I think it's 2% of gift value is associated with education. That said, we're only capturing people from 20 onwards. So perhaps if there's some gifts that are associated with expenses during university at younger ages than that, we're not capturing them. And we also don't get people who are living in university halls as part of our data set. So there's a chance we're missing some transfers that's going on there. So I wouldn't say that this kind of shows that education is necessarily only a very small proportion of gift value overall in a situation in which we're perfectly capturing everything.
And maybe to come back on it, do you think, as well as the kind of potential for missing some forms of the transfers, which I guess would only make these, bigger as an issue to the extent that we're missing, to what extent do you think we should be thinking more broadly about, maybe to go down David's point, what extent do you think we should be, as social scientists at least, thinking more broadly about these connections between parents and generations? I say that in part because there comes as another question further down here that I don't think we have a great answer to, but is what extent are children paying the social care costs of their parents? What would we be looking for in data, or how should we be collecting data now to think more about these links between the generations?
I think there are different ways we can get at kind of these transfers beyond asking about financial ones. So as kind of both Davids have mentioned, we could think about transfers that aren't coming in financial forms. We could think about co-residence, for example, as a form of transfer from parents to their children, or even at older ages from children to their much older parents, perhaps in a later stage of life. So we can think about co-residence as also about practical help that children are providing, or the kinds of forms of exchange that are associated with perhaps being more likely to live in the same area as your parents. So I think perhaps adopting a kind of broader definition of transfers would help build a broader and wider picture of exactly how generations are helping one another and how these kinds of exchanges are taking place.
David, sorry, do you want to come in on any of this kind of measurement of these links and
I guess
between the generations?
Yeah, I completely agree with what Bea was saying. One thing which is surely going to become a growing issue is, as the question was asking, about payment of social care costs. And that is one area where we kind of have, I think, a particular data gap with just who's going into care homes and how they're funding it. And so I think even aside from these intergenerational aspects, we would want to have better data on that. So that's something that we should think about. And then more broadly, ideally, we'd really love to have just more data where we see both parents and children and know about all of these different transfers happening at the same time. And that would be kind of a great addition to our data.
Of course, there is another data set that's of some relevance, which is time use data. And that captures time devoted to children and also to other relatives. And I think it's Jane Falkingham and her team at Southampton have done some quite interesting work on whether, for example, including some of these questions, whether children who have received financial support already from their parents are more likely to devote time to caring for the parents when the parents are old. And I think her research did show that some of that reciprocity, but there's certainly a body of work from the Centre for Demographics at Southampton on that issue.
Thank you. That sounds very interesting. There's a one that's just been posted, got a few likes, but I think is quite an interesting question, and I don't know if we know about it in the UK, but maybe we know about it more broadly in other countries. Do people receive gifts? Are people who receive gifts more likely to start businesses? Is there a kind of role for these these gifts as getting over credit constraints, providing capital for new productive businesses, exactly the kind of thing we kind of need to help us out of the productivity slump that we're in. I don't know, anyone know any literature on that or evidence on that?
Something I can say about what we've done is that we actually don't find that it seems to be a large proportion of gift value, at least so far in the data. So using gifts to start a business is less than 1% of gifts received, and the same for kind of gift value. So it's not even that it's kind of more valuable and very infrequent gifts, doesn't seem to be driving it. And it's the same when we kind of use our regression analysis and look at transitions from employment into self-employment, for example. There doesn't seem to be a connection there. And, there's a chance that there's some stuff that we're missing, and there's a chance that this assistance is coming through different forms. But I'd say it doesn't seem that in the UK so far we're seeing strong connections there.
There is a bit of I'm sorry. You go on, Dave.
I mean, it's not quite precise, but there's certainly evidence that, for example, you're much more likely to take out a patent if you have rich parents. There's evidence that setting up a business is hereditary. If your parents have done it, you're more likely to do it. I think there's evidence that home ownership is associated with setting up a business. So there are various, as you were saying, there are clearly capital constraints, and these type of transactions you'd have thought might help with those capital constraints.
Yeah, I was going to point to the same stuff. There's this kind of idea, at least in the US, of the kind of missing entrepreneurs, because we see that you're much more likely to set up a business and file a patent if you've got wealthy parents. And so, might there be other people who could or would do that if they had access to some capital?
There's a question here about, and I guess this was a little bit earlier on in the presentation, looking at the timing when it was asked, are these not more likely to be consumed rather than saved? And whether the implications of that, if people do consume these rather than save them, what do B or David, or do you have any thoughts on that, or have we kind of just answered that this is mostly about property?
I can say something. So I think, as B pointed out in her presentation, these transfers are more likely to be used for kind of meeting living costs and spent on other kind of day-to-day things for people who've got lower levels of wealth and whose parents are less well off. So you might think that would kind of further exacerbate these kind of different impacts on wealth. I guess, it's worth us saying that it's not like it's a bad use of wealth to be spending it potentially. It might well be that, if you're less well off, then it's a good idea to be spending it on your current living expenses because that is your priority. But in that way, it might kind of reflect just the differences in people's ability to kind of capitalize on receiving some wealth in terms of the, further knock-on consequences for reducing their housing costs or getting access to that higher return asset. So yeah, there are some very important differences there, and certainly some of it is just spent on living expenses.
Here's another one. I don't know if David Willits, whether any of the work of the Intergenerational Commission reflects on this at all, or our own work at IFS. The question here, whether you say at the moment we're looking at things between transfers between children, parents and their children. In 20 years' time, as this kind of richer at least this is my interpretation of the question, 20 years' time as the richer generation, maybe born in the 50s or so, gets older, should we be thinking more about the more in 20 years' time about the links between grandparents and children, or grandparents and their grandchildren? Is there if there's no skipping generations now, do we think that might become more of an issue in the future? David Willits, any thoughts?
Well, and you touched on this in your research presentation earlier. It was interesting, but certainly I do think that the skipping the generations phenomenon will become more significant as we're heading for a median age of inheritance over 60. And it would affect the measurement. It could happen in two ways. It could happen either explicitly as the grandparents giving money to the grandchildren, or it can happen with the parents as the intermediaries, and they are the heirs, and then in turn gift on. And so it would show up in that form of gifts. But I do think that we're in a world where inheritance, and as well as these kind of gifts we're talking about today, matter increasingly, and their significance is going to grow further.
And that's one of my IFS colleagues comes in on that. There's a question here about the structure of inheritance tax. Do we think what are the implications of this work for the structure of inheritance tax? And David Sturrock, I know you've done some thinking about some issues to do with inheritance tax, but do you have any thoughts there?
Yeah. So we do know that people, particularly near the end of life, as I was kind of saying earlier, and particularly those who are going to be affected by inheritance tax, who have more wealth, do sometimes do things to try and get around inheritance tax and pass on wealth earlier. One kind of natural response that at least economists would advocate would be to be taxing the lifetime flow of wealth that people receive rather than taxing estates left at death, both because that removes the kind of incentives to be moving wealth around during life, also because it seems to kind of make more sense to be assessing based on the resources of the receiver rather than on what's being left over. But of course, these sorts of policy prescriptions are pretty controversial and very unpopular, really, frankly. David might have other views on that one. Be interested to hear.
Well, I do think that you're absolutely right, David, in describing the economically rational view of all that. And operating now from the safety of the House of Lords, no longer in the House of Commons, I'm more tempted by it. But I think the other point which comes across in your research, these type of exchanges are popular. People like the idea that parents should help their kids, and that if you work hard and build up an asset, you should be able to pass it on through inheritance to your kids or grandchildren. And trying to tackle that head on, I think, is very hard. That's why the policy approach that I think is more effective, and you guys are the expert on policy, but is instead to say, look, this is so admirable that we ought to try to spread it more widely. We ought surely to be able to do something to plug the gaps for the people who can't benefit in this way. So in other words, big up the instincts that lie behind it and then try to generalize them rather than getting into a position where you appear to be attacking them.
I think that's a very nice thing for us to reflect upon in terms of these results, and in terms of the potential different policy options that come out of here, and indeed the different opinions that people have towards how either useful or concerning these kind of trends are. And there are, as I said, I think I said earlier, reasonable areas to disagree upon, depending on our own people's own preferences. But it does really very much seem that irrespective of preferences, that all these issues are going to become increasingly important over time. And so I think at that point, I'd like to thank David Willetts very much for joining us, my colleagues David Sturrock and B. Boileau, and of course the funders of the work who have really facilitated this, the IFS Retirement and Social Research Council. Please do look at our website for upcoming events on wealth, pensions, savings, labour market, and all the vast attacks and the vast set of things that we do at IFS, and I hope to see you all again soon. Thank you very much.